Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor, and we have gathered here this morning, three sports experts. We have an expert in Canadian ice hockey, Graham Witcomb from Vancouver. We also have an expert in baseball, believe it or not. This will become apparent why we need these experts. Nick Cummings from Newcastle. I don't know how you managed to get into baseball, but all will be revealed. And I'm obviously an expert in English Premier League, you can tell by the accent. We will talk about sport and sports companies, and one particular opportunity that we found in the US, believe it or not, which involved bats and balls. Okay, but first, big news last week. Or was it this week? It was last week. Cochlear, after a string of disastrous announcements in the Australian healthcare sector, CSL has fallen from grace. ResMed got hit when GLP-1s came out, and is now sort of trading at reasonably attractive prices. But Cochlear, the prince of the healthcare sector, has been smashed lately. And we thought we'd talk about this first, Graham, because this feels to me like eerily familiar with CSL. What's going on at Cochlear?
Well, yeah, you're exactly right. This is not the best time to be a healthcare analyst. But in terms of Cochlear, it's its most recent brief that came out, the kind of top line was that it cut net profit guidance from 435 million or so to 290 million, which is a huge amount for Cochlear, which should be this extremely stable company. It's been growing at 10% a year or whatever it is over the past 20 years. So to lose such a large amount in just a few months, it seems, because management had previously put out their guidance in February.
So what's that? That's about a 30% cut in guidance? Profit guidance?
Exactly. Yeah, so it was a huge number, but what was kind of surprising about it was then management went and listed all the things that had led to it, and it was a huge list of different factors all working against it. So there were issues with their developed market sales, their hearing aid referrals were down, there was surgery capacity constraints, there's the Middle East disruption, foreign exchange issues, China cut its reimbursement rates. It was just like, you could not believe this 2 months had all of those things baked into it. So I think that scared investors a lot because you shouldn't have that kind of thing happen for such a stable company. And it makes me wonder whether this is the start of another CSL kind of fiasco where things unravel slowly over time, or is this really the stable company we thought it was that's kind of going through a rough patch but is going to turn around pretty quickly?
Can you explain what exactly is going on? Why has the share price been hit so hard? And does this look temporary or permanent?
I think there's two things going on. The share price has gone down significantly, more than 50% since February. And I think at least part of that is just due to the destabilizing factor of being shocked that something that should have been stable, that had commanded a premium valuation, suddenly lost that glisten to it. And so there's that kind of factor that's gone into it. The other were those different issues that they laid out. I kind of wonder whether there's a bit more to it than what management has suggested, because all of them seem to be, nothing in there seems to be particularly gruesome. So to get from a bunch of, albeit a number of different small effects leading to this huge 30% drop in their earnings forecast seems to be quite remarkable. And it probably also reflects management's lack of conservatism in making that forecast, I suspect. That might be the bigger thing, that things were kind of turning at the end of last year. You could see its interim result in February wasn't as pretty as they have been in the past. And my guess is that management just tried to hold on to the belief that things would turn around quickly. They then made an optimistic forecast for this coming period, and then have now had to quickly backpedal when things got worse over the last few months. So yeah, a few different things at play.
What about Cochlear's had this incredible pricing power. It basically invented the category. And you're now suggesting that maybe that pricing power has peaked, which would be a long-term detriment in the business. Do you think that's true? And if so, what's behind it?
Yeah, I do think that Cochlear's pricing power has peaked in a sense. So once someone's had the implant, then Cochlear does have a fairly good amount of pricing power for the upgrades of the external processors, because it's the implant is stuck in their head. They have to stick with Cochlear as a brand. So that's a pretty good way to keep raising prices. In terms of actually selling
there's no
the
better
implant,
form of customer loyalty than having something stuck inside your own head.
No, when you have to have something surgically implanted, that is excellent customer captivity.
Yeah, flybys, absolutely died in the arse compared to Cochlear's.
Yeah. So in terms of their services revenue, their kind of repeat sales, I think that does still have unusually strong pricing power. The difficulty is with the sale of the actual implants, that does seem to have reached its peak. And given they're kind of 20 grand a hit, it's not too surprising that at some point the insurers or customers, if they're buying them themselves, though that's rarer, will be kind of having to weigh up the pros and cons of that. They've been raising prices consistently for almost 20 years. But this recent half seems to suggest that did hit its peak. Management admitted quite freely that they raised prices a few percent, but that had a disproportionate effect on sales volumes. Some of their competitors are priced quite a bit cheaper, and that seems to have affected the company quite a bit, because they've moved further and further away from selling mainly to infants, where it's all fully insured usually, and so it's not the customer actually paying for these implants.
Right.
They've moved more over the last few years into adult sales, because they were running out of infants to treat essentially. And when you're selling to seniors, that's maybe only partially insurable or whatever, and so they're getting, I think, hit by a bit of pushback with just the rising cost of living generally, and a very expensive, somewhat discretionary item.
Yeah, it's not a cheap product, is it?
No, you can buy a car.
Yeah, about the cost of a car. Nick, when you see a situation like this where a company is kind of shocked at how quickly its business has deteriorated, what's your natural reaction to these kind of circumstances? Because we've all seen this play out in a particular way. Does this strike you as being conforming to the sort of mental framework we have in our head, where you get a company that comes out with a very poor result and seems to be surprised by it, and there's a whole range of factors that explain it? Does this conform to that view, or do you think this is different?
I'd probably say it conforms. I mean, there's an old saying that, downgrades come in threes. I think part of that saying is just because management is usually overconfident. The people that are leading these companies have usually been extremely successful at just about everything they've done in their lives. That's how they get to these roles. And so when a hiccup comes along, it's just natural to think, I've overcome obstacles before and I can get this going back in the right direction. So I don't need to be conservative with my guidance. But a lot of the time you can't. And then the next downgrade comes, and eventually the last one is when they just kitchen sink it, because they have actually no idea. They've lost all confidence. And this situation sort of, regardless of whether it's the third downgrade or not, sort of strikes me a little bit similar in terms of, it was only 2 months ago, as Graham was saying, that this company was guiding for, I think, 450 million in profits. And 2 months later, it's now below 300 million. I mean, that's a huge, huge change. And I mean, it's hard to think that, the sales of that January period and just before, when they report in February, weren't already starting to deteriorate. But maybe the management was just a little bit overconfident, thinking that they, a few things would fall in their favour when things have gone the other way. It strikes me as a huge, huge difference in just 2 months. And I guess that's why you've seen the share price respond the way it has. I mean, not only have earnings are lower than what investors thought, but the confidence in the ability to predict the earnings going forward and management's credibility has been lost. So what investors are willing to pay for those earnings has also been, I think, cut in half. So I think Cochlear is now trading at 19 times lowered earnings, whereas before it was like on 30 times these higher earnings. So it's been a double whammy where you have, earnings cut and then the multiple of those earnings cut. So I'd say it probably does conform to that sort of situation. It's quite the fall from grace, and as you said at the start, it's happened across the healthcare sector. It's really surprised me, I guess, over the last couple of years, the multiples investors are willing to pay on the ASX for these so-called quality businesses that aren't probably growing at the rates they used to, but the multiples people are paying are the highest ever. So some other examples would be ARB and Reece, where 2 years ago Reece was on 40 times earnings despite not much revenue growth and not much profit growth, and a US division that was already sort of starting to fail. But I think people were anchoring too much to Reece's prior success and potentially prior business quality, and maybe that's the same case here with Cochlear. And unfortunately, it catches up quickly.
Yeah. Humans generally take a long time to change their mind about something, I think, especially when, the view that you have taken has been financially very profitable for you. It's hard to shift confidence in a company. They really need to fall from grace. But that fall from grace has been incredibly rapid. I'm just looking at the chart here now, Graham. We first recommended Cochlear in 1998. Which would have been about 3 months after we started at $6.30. I actually wrote about this in my book and saying how Cochlear was a great example of a business we should have hung on to and we sold too soon. We sold, we sold a few times, but between, I think, 2006 and 2014, we just hung on all the way through. And then the share price really started to rise, and I think we sold in around 2016, 2017, when the price was up over $80. And in the book, I just explained how that was a massive mistake, and the price was over $300 at the time when that was published. And it's now back down to, under $100. I mean, isn't that... clearly we're sort of interested in a company of that quality that's fallen that far. But Graham, how do you approach this situation and sort of let go of that past that the company has had and try and see it in this new light?
Yeah, it's difficult. It makes you wonder whether our previous mistake was our previous sell was a mistake, or if we actually just got it right but too early. So
I'm going with the latter.
Yeah, we'll have to write a new book that paints that picture instead. But in terms of what to do now, there is still a lot going for the company, and I do think this is a different situation to CSL, partly because it does have a lot more captivity of its customers. It doesn't lose. For its services revenue, for instance, even that was still up 13% this quarter, which that's going to continue to grow as the installed base grows. So even if Cochlear stopped selling any new devices, it would still have growing revenue over the next decade just from the upgrades of those that are already in place.
Right.
And so I think it was fair that we reduced the price guide and the buy price by quite a whack after this. It does change our view of management, and I think it, like Nick said, there tends to be additional issues that kind of show up after the big ones have presented themselves. So I think that it's reasonable to be more conservative at the moment, but at the same time, this is a high-quality company. It's one that has probably still decent growth prospects. It has a very good balance sheet, and now it's going at a price that's much more reasonable compared to even fairly, much lower growth. So I think there is maybe an opportunity coming, but it's worth to be patient. Particularly, I'd love to see the next downgrade in a way, because that might completely spook people and send the stock from a 20 times PER down to something much more ridiculous.
Yeah, I'm going to quote your own words to you. Sorry, Graham, on that point, because I think you expressed this really, really well. The question now is whether the 50% fall in share price since February is finally a buying opportunity or an early warning of deeper problems ahead. For now, we lean more towards the latter. One rat on deck usually means more below. We're willing to let this play out further before making an official upgrade. So you're waiting for Nick's third downgrade.
Pretty much. I'll feel pretty stupid if it does rebound and this is just a completely temporary issue, because the stock does look like pretty good value at the moment. But just history, particularly maybe I've been doubly scarred by CSL, but history says that when you get such a strange downgrade that's so high in magnitude, but also of so many different little factors rather than something that's like
just
very crystal clear. Yeah, it makes you wonder what the next
what else is coming
is going to be. Yeah, I just get some sort of funny feeling. So that's not necessarily the best way to invest, but it can help you avoid issues as well.
No, it can. I do believe this does conform to the pattern. It doesn't mean there will be a third downgrade, but often in these circumstances, that's what happens, and I think it makes sense to wait. Okay, on to our second topic. Graham's favourite subject, sport. Our sports expert, Graham, is in Canada. Graham, are you an avid watcher of, what do they call it, the Canadian Hockey League?
I'm so ashamed of this fact, but I haven't even been to a game despite living here 15 years, so I don't think I fully qualify as a Canadian citizen at the moment.
You don't. It's like me moving to Melbourne and having no interest in AFL. Couldn't care. Don't go. Everybody talks about it. You'll never feel fully part of this city unless you get into that game, I don't think. What about you, Nick? What's your favourite sports pastime?
Oh, football or soccer would be my favourite. But I actually have been to 2 NHL games, which is the hockey league in the US.
Oh, yeah?
Oh yeah, I recommend going, Graham. It's a lot of fun. But I'm a sports nut. I can't get enough of it. Yeah, I could pretty much watch anything, but football will be the favourite.
Me too. Now, the reason we're talking about this is because sport used to be remote from financial markets, except when sporting clubs are asking for money. Now, billionaires are wading into sports clubs and paying up huge sums, often for businesses that don't seem to make much money at all. To me, it looks like a big example of the greater fool theory, especially in the prices that are being paid for in Premier League clubs. My club, Tottenham Hotspur, was the first to list on the London Stock Exchange. It's no longer listed. I think Daniel Levy, the chairman who got sacked a few months ago, was trying to sell it for maybe £3 billion last year. That number is probably going to fall by about a third, I think, if and when Tottenham get relegated to the Championship, which should happen in the next month or so, I think. But Nick, you have been following the Atlanta Braves. And the reason why Atlanta Braves are a baseball team, and the reason why baseball is kind of interesting is because Atlanta Braves, even if they're really, really shit, are never going to get relegated. And this is a massive factor when you're investing in sports teams. You want to stay part of the franchise. So, Nick, just give us a picture of how sport works in the US from a financial perspective, because even the US is the most not radical, but I would say the most capitalist country on earth. Sport seems to run on this very socialist basis.
It does. No, I think that's a good way of putting it. And, contrasting that to the European football model, which is far more capitalistic. It's kind of backwards, right? But no, look, sports leagues or sports teams in general, no matter where they're from, are really just trying to monetize eyeballs. And, there's different models to do this, but from my perspective, the best one by far is the US model from an ownership point of view. And there's a few reasons why. I mean, you mentioned just then relegation. So in the National Hockey League or the NBA, NFL, or the MLB, which is the baseball league in the US, no team can be relegated. And new teams can only join if all the other owners get together and allow them to. And usually there's got to be some incentives passed between all of them to let that happen. So in the MLB, for example, since 1998, there's just been 30 clubs. so that, there is no more. You can't create another one. So there's this huge scarcity premium compared to the, European football, where a club like Tottenham, who's got a 65,000 seat stadium, could potentially, and I hope this doesn't happen, John, but could potentially be relegated this year. So that's one difference. The other difference is in European football, revenue tends to really skew to the top teams. So the Man Cities of the world make a lot more than, say, Wolverhampton Wolves. And that's because of, they play European football, like Champions League, they get more rights, or they share more of the rights. Whereas in the US, there's a much more equal, almost socialist sharing of the revenue from a league point of view. So that trickles down to all the teams. So it is really a different model. And then one other aspect which is kind of interesting is the US has a salary cap in most of their competitions, where that is not really the case in European football. And in European football, there's transfer fees as well. So, you could buy and sell a player for £100 million, and one team benefits, but the other team has to spend £100 million. Whereas that in the US, that doesn't happen. You can trade players, or once their contracts expire, you can then go and offer them a new contract. So there isn't the transfer fees, which just makes for much more stable revenue. There isn't the massive cost blowouts. You don't get a Chelsea situation where they spend £1 billion just to come sixth, or even below that. So it's just a far better model. And then on the last one is just the talent production, if you will. So in football, that is actually all internal. So, Manchester United, there's the famous story about signing David Beckham. I don't know what age it was, maybe like 11 or, maybe even earlier. Yeah. And all these academies and bring all these players through. Whereas in the US, they have a draft each year where the best players are chosen by the teams that usually perform the worst the year before. So talent spreads around and success spreads around a lot more in the US. So this makes a much less volatile model. Revenue is shared more equally, and there's less downside.
Keeps it competitive.
It does.
So it's a better product because the same people don't win all the time.
100%. And you could argue maybe from an eyeballs point of view that the Premier League benefits from relegation in the sense that you don't have any boring games at the end of the season. Like the Tottenham games will be really, really will be highly watched games. Whereas in the US, if you're coming last, who cares? You just sort of run out the end of the season and go to the Caribbean like for holidays. Yeah, exactly. So there's an argument there. But I guess the final one too is. Teams in the US can also move, and this is an important point. So the Los Angeles Rams, they were previously in St. Louis, and a new team owner came in, bought the team, got it signed off by all the other owners in the NFL, and moved that team to Los Angeles. Now, Los Angeles is a 18 million person market compared to probably, 2.5 or 3 million in St. Louis. And you can imagine how well that's done for the valuation of that team and the revenues of that club. And so that exists in the US too. So owners have a lot of control compared to, say, moving Tottenham. I don't think you could do it. You wouldn't want to do it.
You can't do it.
Yeah,
they couldn't even move it to Stratford. There was like 4 miles away.
Yeah, exactly. And this brings us back to the Atlanta Braves. So the US model, I think, is far better than the European football model. And the Atlanta Braves are this sort of outlier asset where they're the only listed sports team in the US. So there's another club that's sort of a part of a conglomerate that's listed, and then there's the Madison Square Garden Group that's got a hockey and NBA team, but it's not as clean as the Atlanta Braves. So it's a real outlier asset. So in baseball, 28 teams are unlisted, one in a conglomerate, and then there's the Atlanta Braves. And our thesis here is we think eventually that someone will come along and acquire this team because at the moment, it's sort of an inverse private-public arbitrage where usually public companies buy private ones for cheaper, whereas private baseball teams and other teams trade for massive multiples that are higher than what the Atlanta share price is or the Atlanta market cap is today. So that's what we're hoping.
And that's because it's basically only billionaires that can afford to buy them.
Yeah. And as you said at the start, it's a bit of the greater fool theory, but sports valuations have done well over a long time. They've outperformed the S&P 500. It's sort of a way in the US. It's almost like I feel like their version of knighthood, buying a sport team. It's
That's
almost
a good way of putting it.
Yeah, a way of saying I've made it. And there are, as always, with some things in the US and billionaires, there are some tax advantages of doing so. So about 80 to 90% of a team's price is intangible. So things like player contracts and league rights and TV rights, and all of these can be amortized over about 15 years and written off against other income for that billionaire if the structure is set up right. Yeah. So famously, Steve Ballmer of Microsoft Wealth, he bought the LA Clippers, I think for over $2 billion back in 2012, and he's sort of been doing this and able to write off the dividend income he receives from his Microsoft shares and wherever else he's getting cash coming.
I have no problems with Steve Ballmer buying a sports team because he can sweat like a professional athlete. Like that guy can really sweat.
Yeah, and he brings some of the same energy on the sideline as, in some of his, the developers speech. Do you remember that?
Yeah, I do. Developers.
Yeah.
How could I forget? I haven't bought this stock. I've read all of your research on it. I thought about it. It's a very interesting situation, I think. I wouldn't call it obscure, but it's not conventionally the kind of stuff that we would invest in. But we're only doing it because you bought it to us and you know this market fairly well because you lived over there for a few years. You understand how it works. Graham, is this something that attracts you? Obviously, you're not going to go to the Atlanta Braves and watch a game. But what about the opportunity itself?
It does. There is something about it that it's definitely not a conventional investment case, but I really like the idea of analyzing a repeatable kind of human behavior, which is how these billionaires treat these assets. And I think when you combine that with the idea of the merchandise sales and the rest of it, that maybe it does all kind of add up to something that is quite unusually mispriced right now. I can definitely see the case for it, and I like that it's something different. It's the only one in the world that is like this, and maybe you have to treat it a bit like News Corp or something or other in the old days, where its value isn't as obvious as just a standard kind of cash machine.
Right. Now, Nick, there is something that when you brought this to our attention 3 years ago now, almost 3 years ago. The price is up about a third. But there is something on the horizon which means that there's probably a greater chance of transaction happening sooner rather than later. And that's what we're really banking on now. Do you just want to explain that? Why is it that there's more urgency now if you are a billionaire who wants to get your next new toy?
Well, yeah, there's a few things that have gone on recently. Firstly, the owner, which is John Malone through Liberty Media, he has been recently buying shares on market and has now secured 50% of the voting stock, which is typically what John Malone has done throughout his history before some sort of transactional merger takes place. He usually likes to secure control. So that's probably a step in the right direction for a sale. The other one is there's a tax change going on in the US that means a company's highest employees won't be able to be excluded from certain taxes. And for most companies, this doesn't matter. For publicly listed companies, it doesn't matter as much. But for the Braves, because they are publicly listed, this will mean the players' salaries, which are tens of millions of dollars, won't be excluded. So they'll be in a disadvantage to the unlisted teams where this tax change doesn't apply. So it could be a $19 million headwind for them. So it just creates a little bit more urgency to sell. And then I guess lastly is, two things is, firstly, baseball is now in a better place than it ever has been. So they changed the rules a couple of years ago to speed up the game. Essentially, people were pitching the ball and taking 2 minutes in between pitches, and the games were lasting 4 hours, and it was getting a bit boring, and only the diehards loved it. They've sped this game up a lot, and viewership is up a lot over the last year, and that looks sort of to be continuing early in this new season as well. And then secondly, there was recently a large transaction. So the San Diego Padres were bought for $3.9 billion on a multiple of about 8 to 9 times revenue.
Right.
And if you apply that same multiple to the Atlanta Braves, the share price should be roughly about 60 to 75% higher. So that's sort of what we're playing for. That I think the multiples of revenue that the Braves trade on currently is very, very low compared to where private transactions get done. And I would argue that the Atlanta Braves are a far better asset than this San Diego Padres as well. So there's a few things going on. A couple of reasons. Atlanta is in this unique spot where in the surrounding 7 states, there's not another team. There's a team in Florida, but there's no team in the Carolinas, no team in Tennessee, no team in Alabama. So the nearest baseball team is 650 kilometers away from Atlanta. So they have this sort of massive I guess home ground advantage where they can bring eyeballs in from so many different states. So their fan base is just larger than, say, a San Diego Padres. And then the other reason is the market is bigger. Atlanta is about 6 million population compared to San Diego, probably 3 million. So it's just a bigger market. Revenue is higher for that reason. And I'd argue that the team roster is better as well.
Right. Okay, there we have it. Who would have thought that on a niche Australian stock podcast, you would get a detailed breakdown of why we should all be buying Atlanta Braves? This is not a recommendation, by the way. But if you do want to read the research, you'll see that Nick has made a very interesting case. I want to thank you both for your contributions this morning. I think the team played well. I think Tottenham are going to go down. But I'm hoping that Atlanta Braves is going to go up and we're going to get an opportunity with Cochlear. We'll see you all in a couple of weeks.